Okay, welcome to Deloitte's Debriefs webcast series in Asia Pacific. Our webcast today is from our Geography Update series and is titled Tax Transparency Unveiled, First Experience with EU Public Country-by-Country Reporting and Implications for Asia Pacific. I can see we have a particularly large number here, so this must be very interesting indeed. My name is Klaus Schürmann. I'm a tax partner and co-leader of the Asia Pacific Core of Excellence based in Hong Kong. I have the pleasure of hosting today's webcast. I have with me today Andrew Dodona, Andreas Kirsch, and Andreas Kowalek as co-presenters. Andrew is a tax partner based in Deloitte, Australia. Andreas Kirsch is a tax director based in Deloitte, Singapore. And Andreas Kowalek is a tax partner based in Deloitte, Germany. You may access our bios on the left side of your screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box, which you'll find at the bottom of the screen. We'll do our best to respond to your questions during the presentation or at the end in our Q&A session. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with a CPE certificate after watching for at least 15 minutes. Now let's switch to the agenda, please. Okay, let me give you an overview of the topics that we will discuss in the next hour or so. We'll start with global developments, where we'll give you an overview of the latest developments in public country-by-country reporting. We'll then cover Australia's public country-by-country reporting initiative and give a brief look at Australia's new reporting measures. Then we'll move to first hands-on experiences with EU public country-by-country reporting in Romania, which was the first country to actually implement these. We'll share some insights and lessons learned, which are relevant for Asia-Pacific companies. We'll then switch gears a little bit, move tax governance and ESG, and practical implications for tax governance and alignment with ESG strategies. And lastly, we'll have a virtual coding discussion among the presenters. We'll discuss what are the pillars of public CbCR strategy in a global environment. With that, let me hand it to Andreas Kirsch.
Yeah, thank you very much, Klaus. Next slide, please. So first of all, I would like to give an overview about the latest development in tax transparency and public CbCR. On the left-hand side, you can see various countries, and we have indicated what kind of public disclosure elements these countries have. So mainly, especially the EU member states refer to numbers, so the publication of the CbCR. Some countries also require to publish a tax policy, not so many. We have moreover indicated what's the status in terms of tax governance requirements. Especially in the EU, there are some countries with tax governance requirements from an Asia Pacific perspective. These requirements, these jurisdictions refer to Singapore, to Australia, and Malaysia. These jurisdictions have dedicated tax governance requirements. From an overarching, so global perspective, we have the ESG sustainability status. And for ESG, the G is actually also part of the sustainability reporting, and tax transparency is part of that. So more and more companies are actually including tax transparency as part of their ESG sustainability reporting. Next slide, please. On this slide, I would like to give you an overview about the essence of public country-by-country reporting and in particular, what's the difference to the well-known OECD CbCR? I think on the left-hand side, I think quite intuitive. It's about reporting the total revenue, the profit and loss before tax, and also the cash tax paid. What is new, especially when it comes up to the GRI 207 and Australia, because Australia has adopted these standards, is the reason for the difference between the accrued corporate income tax and the statutory rate. The next slide, please. I would like to introduce our summarizing example, to which we will refer regularly in the course of this presentation. On the left-hand side, you can see the requirements or the facts. So we're referring to a Hong Kong-based group with a headquarter in Hong Kong. Also, the ultimate parent company is based in Hong Kong. The group has revenue higher than 750 million euro, or and Aussie dollar 1 billion to fulfill the reporting requirements for public CbCR. We have a Romanian entity, so an EU entity that meets at least 2 of 3 criteria. Either the 4 million balance sheet total, 8 million euro net profit, and 50 average number of employees during the relevant financial year. The Australian entity has also turnover higher than 10 million. So this group, at least simplified in our example, has entities in Hong Kong, Singapore, Malaysia, Romania, and Australia. Even though only Romania and Australia have dedicated public CbCR rules, all these entities in these jurisdictions reflected here are affected. We will show and come to that later during our presentation. Next slide, please. And hand over to Klaus.
Okay, now we are starting to make this all a little bit interactive for everyone online. Let's start with a polling question. First one. So the question is, how ready are you for Australia's public CbCR? The options that you have, and please click what is the view in your company. The options: we don't know if we are required to report, but we will report voluntarily in line with the group's approach to transparency. Or we don't know if we are required to report, but we still seek an exemption if possible. Or we don't know if we are required to report, but we will report if required. Or we know we are required to report and will only comply with the minimum requirements. Or we know we are required to report and will report more than minimum requirements. Or finally, we haven't thought about anything. So please make your choices. And while you click, quick question, Andrew, to you while we talk about Australia. Many in-scope groups did not have Australian public country-by-country reporting on their radar. What triggered Australian public CbCR in the first place?
Thanks, Klaus. I think that's a really good question. If we think about transparency broadly around the world, it's to keep governments organised about the amount of tax that they collect from corporates that are operating in their jurisdictions, and also just to help the public understand how they're spending their tax. Here in Australia, I guess we are in a position where there are lots of multinationals that come into Australia and sell product in Australia, and the political debate has focused on how much tax those companies do pay. And so building on this narrative that has been in the media, we have seen that the government wanted to respond by showing that it was being quote unquote tough on multinationals and keeping them to account. And so building on the broader regimes that we're seeing around the world, there was a desire for Australia to be seen as a leader in transparency, in ensuring that companies are honest about the amount of tax they pay. It's fair to say that the rules that were initially proposed in the first draft were certainly more extensive than we had anticipated, and the final rules that have been adopted reduced somewhat, but they're still fairly extensive. So it'll be interesting to see how people respond. Looking at the results on the slide, it's probably not surprising to see that most people haven't thought about Australia yet. The rules have only recently come in, but it is something that people will need to turn their mind to. And I can also see that most people will be looking to only comply with the minimum requirements. So that's a really interesting point to talk about in today's session. So maybe moving on to the content. Next slide, please. And next slide. So my transfer pricing colleagues recently did a deep analysis and deep dive into the reporting measures. A link to that presentation is in the top right-hand corner of all the slides relating to Australia. And if you haven't watched that webinar, I would strongly encourage you to do so because it is very informative. For today's session, I'll be providing just a quick overview so we can then focus on some of the more strategic elements. So in terms of this slide here, as mentioned, the rules were only relatively recently introduced with effect from 1 July last year for reporting periods commencing on or after 1 July. Practically, what that means is most companies will be reporting for FY25 and they'll need to report those figures by the end of FY26 because reporting is due 12 months after the end of the relevant period. For certain groups, this might mean that their reporting slips into FY26 and FY27, but for most people, you should be starting to think about it quite soon. There is a penalty regime that applies, regardless of whether the reporting entity is an Australian entity or an entity located overseas. In addition to the financial penalty, the current one is included on screen. People should also consider the reputational impact of non-compliance. In terms of who must report, as Andreas mentioned before, we're talking about global groups that have a turnover in excess of $1 billion Australian, and there's Australian sourced income of $10 million or more, and the group has an Australian presence. Now, several of those factors might be really clear to understand, but some of them might need further investigation, and this is something you'll need to work with your advisors to understand. In terms of the reporting group itself, two things I'd like to note. The first is the rules refer to a constitutional corporation. Now, this is not a definition that is commonly used in Australian tax law. And importantly, it relates to the legal status of an entity, not the tax status that is afforded. So there have been lots of conversations, particularly with North American groups, where you might have a company but has a different characterization for tax purposes. Now, for the Australian public by country reporting rules, you need to look at the legal status of the entity. And again, that might be really easy for some. For other groups, it will be more complicated. There are expected to be limited exemptions that apply, largely on the grounds of national security or instances where an objective party that's independent would say the information produced is commercial in confidence. Groups therefore need to firstly assess, are they going to be caught by the rules? And then secondly, are they eligible for an exemption? But the government has made clear they do not expect exemptions to apply broadly. In terms of the disclosures, the format of the disclosures are still being refined and the tax office is due to release further information. But ultimately what will happen is groups will need to provide their information to the tax office and that information will be published on an external website that is operated by the government. Importantly, the data points produced will not have a narrative that explain why you pay an appropriate amount of tax or why you are structured the way that you are. And so if groups wish to include a narrative, which is strongly recommended, they'll need to prepare that themselves and publish that on their own website. Next slide, please. Now, the next two slides cover both general and specific information to be reported, which I won't go into detail, but there are two things that I would draw your attention to. The first is the interpretation. Now, unlike a lot of tax law where the guidance is relatively black and white, in the Australian rules, an interesting comment was noted that disclosures should be made so as to best achieve consistency with GRI 207. Now, that's a standard that is promoting the transparency of an organization's tax, an understanding of where it pays tax and why it pays tax. And in my mind, that's a much broader threshold that needs to be considered. And so groups should carefully consider that requirement when they're determining how they report information. The second point to note is the data sources. Unlike other regimes overseas, in Australia, you have to use numbers that are based on information that is referable to audited financial statements. Now, for those that produce audited financial statements, that should be easy to do, but might not be your preferred data point. However, for other groups that don't produce audited financial statements, you'll need to obtain information that would be published in audited financial statements if you were required to produce those. So that might mean that groups need to create data points that they don't currently have. And again, that can take some time. So something to plan ahead for. Next slide, please. This next slide shows at a very high level the more detailed information that needs to be produced. But the important thing to share with you is to help you understand that some of the data points will need to be, well, all data points will need to be separated out for Australia and the specified list of countries, which I'll come to in a moment. And the other jurisdictions can either be separated out for each country in your group that's not specified, or they can be consolidated. Now, that's a strategic decision that you'll need to make. I think the survey results before showed that most people want to report only the bare minimum, but there are some broader considerations that you might need to think about. The next slide, please. This list here is quite similar to the black and grey lists that exist in Europe, but in particular, what I wanted just to bring to your attention, some of the circled entities which have just moved slightly, but the ones to draw to your attention are Hong Kong, Singapore and Switzerland. So Hong Kong and Singapore obviously relevant for this audience here, and also Switzerland as well, that might not otherwise you might not otherwise expect would appear on a list. Next slide, please. So coming to the worked example that we have used before, as Andreas explained, we have a Hong Kong company that is head of this group. Given that Hong Kong, Singapore and Australia Hong Kong and Singapore are on the list, so they will need to separately report the specific information. Australia will need to report that as well. The group will then have a choice as to whether they report Malaysia and Romania on a consolidated basis or whether they do so on a standalone basis. And so that's a strategic consideration that they'll need to consider in terms of their own internal processes, management guidelines, also looking at their external stakeholders and their peer group. And we'll bring that to life a little bit more, those considerations in the conversation a bit later on. So Klaus, I might then come back to you.
Thanks, Andrew. Thanks. So that brings us to the next polling question, and let's see if we get more answers than in the first one. So what is your group's EU Public CbCR position? That would be the question here. And I'm not reading out the different options. Please go ahead, make your choice. And while you are busy with this, let me raise a question to Andreas in Munich. Andreas, Romania, as the early adopter of the European Union's public CbCR, how many groups had to prepare and file an EU public CbCR in Romania for the fiscal year 2023? And once EU public CbCR applies to all groups from FY 2025, how many global groups are likely to be in scope, please?
Yep, so Romania, the expectation is that we will have about 280 groups for fiscal year 24 or fiscal year 24-25. In Romania, until now, we've only seen 31st of December, so we don't know yet how many groups will file by the end of March. These are, for example, groups that are based in Asia. So, for example, Japan groups typically have a 31 March fiscal year end. Total group worldwide will be up to 8,000 groups, so quite a large number. So Romania is only a very small fraction, of course, but as a forerunner, of course, very interesting to see where things could head. Okay, so we've got the results. So that looks quite interesting. So we can see Romania is a forerunner, definitely, but we can see the large bulk of groups will probably be affected from fiscal year 25 on only when we move into the general EU framework, which I'll explain starting from now. Perfect. So this brings us to the EU Public country-by-country reporting section of this webcast, which I've subdivided into two sections. So first, I will cover a quick overview of the general EU Public CbCR rule set, and then also the timing of those rules in the EU countries, which is confusing. As you've seen, we've got Croatia, Romania, etc., the general rule set. And then secondly, what I will do is a deep dive into Romania with you, since Romania is the early adopter of EU Public country-by-country reporting, where the first filings have already been made for the fiscal year ending on 31st of December 2024. We've got a large other chunk coming 31 March, so we don't know yet how many those will be. Total in Romania will be about 280. So it gives some indication, but of course it's not representative of what everything will look like by the end of 26 when everybody files. All right, so let's move on to the next one. So quick overview of what the rules are now with the focus on EU general rules. Here you can see visualized the scope of EU public country-by-country reporting, which is surprising in certain regards. So at the top right, you can see that the EU directive contains various elections which the member states that locally implemented the rules could exercise. So what is important here is if a non-EU headquartered group, like the audience here, is subject to EU public country-by-country reporting, and that group has nexus in more than one EU member state, a non-EU headquartered group can freely pick from the list of nexus states its preferred EU member state for the publication. So that also adds the complexity that these elections, etc., must be evaluated then for each state with nexus. As you can see at the bottom right, in red, yellow, and green, EU Public CbCR applies for three different ways with regard to the first-time application. So the first adopter was Romania, where the rules already applied from fiscal year 23. What is important there, of course, you're only subject to these rules in case you have nexus in Romania. The second adopter will then be Croatia, where the rules apply since fiscal year 24. And then in all EU member states, the rules will only apply from fiscal year 25. So if that fiscal year starts after 21 June 2024, so we may have groups who are already in scope with fiscal year 24-25, but the majority will only be subject to the rules starting from their fiscal year 25. If fiscal year 25 is calendar year, then definitely only 25. That requires filing by the end of 26. As you can see in the middle right in light blue, what tends to add real confusion is the jurisdictions for which a per jurisdiction disclosure will be required. These are all EU member states, all EEA member states, of which there are only 3, and then all non-cooperative tax jurisdictions. At the left, you can see all the EU member states on the map, and we've also added with circles the 3 EEA member states. We will cover the non-cooperative tax jurisdictions and the complexity related to those later in my section. So please move to the next slide. This next slide here gives you a quick snapshot of the EU Public CbCR rules. So in the interest of time, I will not read out the content, but we'll just cover and highlight some key points. So EU Public CbCR involves a new external disclosure of income tax related information to the general public. That information you must disclose is currently not readily available in that level of granularity and detail under other rule sets. So for example, under IFRS rules, where such jurisdiction disclosure is not required at the moment. At the bottom, you can see that EU public country-by-country reporting, as Andrew already mentioned for Australia, in fact, not only requires 1 disclosure, but 2 disclosures, which is also confusing. So first, the 1 disclosure must be done in an official EU public register in a defined data format, which I'll cover later on in my section. And then secondly, you need to do a so-called website disclosure of the data set. For the website disclosure, the EU member states could locally implement a so-called website exemption. This website exemption avoids a full double publication of the EU public country-by-country reporting data set. Note that only about 50% of the EU member states actually exercised this relief. So it's quite important to pick whether you are in a jurisdiction that has implemented this relief. The best approach for website disclosure at the top right depends on your industry, your product and service offerings, your customer profiles and portfolio, your global peer group, quite importantly, and then also the potentially interested parties. So internally, this could be the CEO and the CFO. Externally, this could be lobby groups or other activists, or potentially even pressure groups. At the bottom right, you can see that Deloitte can support you in all the EU states with both the disclosure in an official EU register and then also the website disclosure in Europe. If you do need help in this regard, please do not hesitate to reach out to us so that we can support you. Please move to the next slide. So what I've brought here is a visualization of the final EU Public CbCR template, which the EU Commission published on 29 November. So again, just some highlights. I'll not read out the content to you. So you can see the template contains 5 sections. So general master data, you need to provide finance data per jurisdiction, business activity per jurisdiction, a list of omitted information, and then non-mandatory, a reconciliation of corporate income tax accrued to corporate income tax paid. For those of you who know country-by-country reporting, this sounds quite familiar because most of these data points resemble or are very, very close to what we know from OECD country-by-country reporting. Importantly, if you already prepare and file an OECD country-by-country reporting data set in your headquarter jurisdiction, this data set can be used to populate the EU Public country-by-country reporting template. As mentioned, EU Public country-by-country reporting then requires per jurisdiction disclosures for all EU member states, for all EEA member states, and also for all non-cooperative jurisdictions on a per jurisdiction basis. All the other jurisdictions can be aggregated into one line for the rest of the world, which is shown in green, highlighted on the screen. As you can see in blue at the bottom right, the EU Commission has defined extensible hypertext markup language as a technical format for the template, and also requires content markup in extensible business reporting language. That's very confusing and very technical. The point to remember here is this is not the format you use for OECD country-by-country reporting, which is XML. Please move to next slide. So perfect. So we are now moving hands-on into Romania, and we'll quickly briefly look at what is our hands-on first experience from Romania with the local EU Public country-by-country reporting data sets that have been prepared and disclosed locally in Romania at 31st of December. So as I mentioned, we've got another batch coming 31 March, but 31st of December, we have already some experience on what happened in Romania and what were some interesting insights. So let's move to the next slide. Oh, perfect. No, sorry, it's back one slide. So this slide contains a snapshot of EU Public country-by-country reporting rules in Romania. I will just cover some highlights in the interest of time. As you can see at the bottom left, so Romania fully follows the locally implemented EU Public CbCR rules from the directive. So Romania is quite representative of what will happen in all the other countries starting from fiscal year 25. Romania has implemented the so-called website exemption. So this would have allowed to avoid publishing 2 data sets, which is definitely a relief for most in-scope groups. At 31 December 24, however, this website exemption in Romania did not help us since the Romanian public register was not yet available, so that all in-scope groups had to publish their EU Public country-by-country reporting on their website to comply with the disclosure obligation. The reason is that the Commission only published the template at the end of November, so Romania couldn't get their public register up and running by 31 December. If you require more details or information on Romania, I recommend that you view the recorded webcast, which you can find at the top right corner of the slide. It's available free of charge. You just need a registration. Follow the hyperlink. Let's move to the next slide. So what I've brought here is the local Romanian adoption of the final public CbCR template, which the Commission published from a Deloitte client disclosure, which we prepared at the 31st of December 2024. So again, just some highlights. As you can see, the Romanian EU Public CbCR dataset must be prepared and disclosed in Romanian language. So that's surprising to some groups. You cannot pick the language, but the language is dictated by the jurisdiction in which you disclose. So Romania is Romanian. There's no ability to do it in English. That's a technicality, of course. The output is in Romanian. The data set as such, of course, can be drafted in English. This client here exercised the so-called OECD CbCR bridge election, which is shown at the top left. This client here only reported master data, finance data, and business activity information in sections 1, 2, and 3, but they did not report any information in sections 4 and 5. That aligns also with other information we have from clients. So omitted information is quite rare. Most don't do voluntary disclosures. What was a real surprise here in this client case was the high number of non-cooperative jurisdictions for which per jurisdiction disclosure was required. You can see those highlighted here on screen. These per jurisdiction disclosures also included the usual suspects. So for example, the typical tax haven jurisdictions, some of those you see on screen, but then also Turkey and Vietnam. So that's quite interesting and came as a real surprise because the client didn't have those on the radar. There are some other ones where the same issues will arise. So let's move to the next slide. So what we've brought here, because this always adds complexity for you, is merely for reference purposes, the EU blacklist and grey list with the so-called look-back period. So as you can see at the right, per jurisdiction disclosures with regard to EU public country-by-country reporting data sets will also be required for Malaysia and Vietnam for all EU public CbCR data sets prepared for fiscal year 25, which will come as a real surprise to many in-scope groups. Note that these disclosure obligations then apply to everybody. So basically, fiscal year 25 is the year starting and applicable for all EU member states. Only for early filers in Romania and Hong Kong, such per jurisdiction disclosures may also be required for Hong Kong and Thailand. So another real surprise. So as Andrew mentioned, Hong Kong is on the list permanently in Australia, but only temporarily for the European Union. So we do recommend that all in-scope groups prepare a so-called EU Public CbCR mock-up report at the very latest for the fiscal year ending 31 December 24 to be ready for and also to better understand their per jurisdiction disclosures. If you need help in this regard, feel free to reach out to us. So let's move to the next slide. What you can see here is, again, the case study applied to Romania. So to determine what are the impacts on our Hong Kong-based group. So as explained, EU Public CbCR requires per jurisdiction disclosures for all EU and EEA countries, shown here with Romania as an example. That's just a placeholder. And then also, to reiterate, EU Public CbCR requires per jurisdiction disclosures for non-cooperative jurisdictions. So in this example here, such disclosures are therefore also required for Hong Kong and Malaysia. So that is a surprise to many groups who didn't have this on their radar yet. So I thank you for your interest in my EU Public CbCR section. And now give the word back to Klaus to take us to the next polling question. Klaus.
Thank you, Andreas. Thank you very much. So next question, next interactive moment for everyone. So question is, what's your external disclosure strategy related to the European Union's public CbCR? And the options are either minimalist disclosure of public CbCR only, including the potential hyperlink on a website, or integration of the EU CbCR into existing external reporting framework on a voluntary basis, or we have started an internal discussion and are still evaluating the full impact, or we have not yet started an internal discussion on how best to respond to the EU Public CbCR. So please make your choices. And while you do this, let me ask a question to Andreas in Singapore. Andreas, do you believe that all groups that are in scope of Australian public CbCR and or EU public CbCR have done enough work on fully understanding the impact that these two new external reporting frameworks will have on their future tax governance and also ESG? Andreas.
Klaus, I think we get mixed feedback from the market. At least there are some entities, some multinational groups, especially from the oil and gas industry, that are quite advanced. At least it's common to actually file contribution reports, but there are others who haven't done actually anything, and I think that very good reflects the replies we got for our polling question. So yeah, 53% have not yet started on an internal discussion. So how to best respond to EU Public CbCR. So yeah, we are glad we are bringing this topic up and give our clients the opportunity to work on that. Of course, I'm happy to help. And that brings me to the next slide, please. The next slide. So as already indicated at the beginning, we have the GRI sustainability reporting standards that also includes a section for tax transparency, the GRI 207. And what I brought here is the specific one for public CbCR, so the 2074. If you're familiar with ESG reporting, there are two different approaches. One is called the full disclosure, and the other one is called the partial disclosure. Partial disclosure literally means that some kind of cherry picking. So the company determines what they like to report and then make reference to a GRI. Of course, then it's only a partial fulfillment of the requirements. But even if you do a so-called full disclosure, there are some options. There are actually requirements and recommendations. So if you go for the full disclosure, you definitely need to include revenue, profit or loss before tax, income tax paid, income tax accrued. However, what is optional is also to include other taxes, like, for example, taxes held and withheld on behalf of employees, so salary tax, or GST, VAT, or other indirect taxes. And we can see that, especially I think the oil and gas industry is relatively advanced when it comes up to these disclosures. Next slide, please. Here I would like to touch base on the quality of the CbCR data. So the tax department typically depends on other departments in terms of the accounting data and also the CbCR numbers. However, if something goes wrong, then CFOs typically tend to make the tax function responsible for that, because there's the word tax in the context. So it's good as a tax function to be prepared and to work on the data quality. What we have brought here is actually a table summarizing what kind of situations the tax department may come under scrutiny in terms of the data quality. So the first situation is actually the investor relations, so the public situation. So this can be triggered by information in the financial statements, analyst reports, and the public country-by-country reporting. So if in these kind of situations queries arise or even errors, there's limited time to respond to these queries because any irritation might reduce investors' interest, share price in a worst case scenario. Similar in a situation that is referring to the reputational risk. Yeah. So also here, the public country-by-country reporting could be the source of that potential reputational risk. So if queries arise, you have to ask, you have to be able to act fast, because you have limited time to respond, and typically also senior management of the company is involved. So definitely red. That brings me to the question whether there should be a higher requirement on the data quality when it comes up to public CbCR, simply Simple answer, yes, because once it's live, it's hard to control. This is different in situations like, for example, internal audit. Yeah, this is easier to manage because it's simply internal. You have time to rectify. External audits and tax authorities could still be tricky. Actually, the OECD CbCR is something you also file to the tax authorities. But if questions arise, you have time to rectify, and you have time to manage. Is not that urgent. Next slide, please. So to summarize our example we have referred to before, so as you can see, all our jurisdictions, as I have indicated at the beginning, are affected of the public CbCR regulations in the EU and on Australia, even though Hong Kong, Singapore, Malaysia do not have dedicated public CbCR rules. So that brings us to the end of the presentation. Back to Klaus.
Okay, great. Thank you very much, Andreas. And this time, no more polling question from me, but we switch to the virtual podium discussion. What are the pillars of a public CbCR strategy in a global environment? So let me kick off with the first question to Andreas in Munich. Andreas, how have client conversations in Europe evolved for groups that were required to publish their EU Public CbCR in Romania? Have there been any unexpected challenges? And where do you see the main obstacles? Are they in data collection, ensuring accuracy, or in the actual publication process?
Yeah, thanks, Klaus. That's an interesting one because we did indeed have some interesting insights on this one and some trends. So initially, these were new rules. Everybody was really confused. A lot of people were really struggling with the data and really concerned about the data. People then looked at the so-called bridge election, which EU public country-by-country reporting allows. Then, of course, quickly found out data is not such a problem. Then the question came up much more. Well, what is the content plus the surprises on the per jurisdiction disclosures? So there has been an evolution. So the technical issue was then more, how do I produce the report and publish it? And then what's the contextualization, but not so much the data content or the data collection, because that data is readily available. So Andrew, does that surprise you from a European perspective when you think about what happens or will likely happen in Australia?
I think it's really useful context. I think where Australia is at the moment and groups are at is they're probably still honestly offended by the rules that are requiring them to disclose this information. This is something that they wouldn't have otherwise needed to consider disclosing, and they're often at the moment trying to work out if there is an available exemption for them. There are certain groups that are starting to look at data and trying to work out how they can leverage what they already have from EU country-by-country reporting. Certain groups are looking at data from a Pillar 2 perspective, but it's in the very early stages. I think for going back to the questions that were asked ahead of my session, a lot of people haven't thought about it yet, but I think a key thing that people will need to start thinking about is how they actually mobilize and deal with this in due course, because it is a big change for a lot of groups. And Andreas, then to you from a Southeast Asian perspective, what are you hearing on the ground?
So we've heard from some clients that are interested, or actually, where the head of tax is forced to participate in the GRIs or in the ESG-related public country-by-country reporting. But besides this, clients, I think, are not yet ready for either the EU or for Australia. And I think just questions raised were, for example, whether we can apply the safeguard clause, which gives some exemption in case sensitive commercial data is published, but it seems like this is a very exceptional rule, like, for example, defense industry, and not the rule is for most common groups. Giving back to Klaus.
Let me go back to Australia then to Andrew. Andrew, have Australian multinationals already begun preparing for these new public CbCR rules and requirements? I mean, is Australia's framework, does it include an obligation to disclose the organization's approach to tax, and does it effectively mandate the MNCs to have publicly available tax policy statements?
So I think Australia is in a slightly different position to other countries around the world. For those of you that have groups that are operating in Australia, you might know that the Australian Tax Office is operating a justified trust program, currently called the Combined Assurance Program. Now, under the Combined Assurance Program, taxpayers will be assessed, amongst other things, their tax governance work, which includes looking at an organization's tax policy. So many groups that have been subject to a combined assurance review have necessarily needed to ensure they have really robust tax governance documentation and very clearly are able to describe what their approach to tax is. This is more sophisticated for Australian headquartered groups, but to the extent there is a offshore headquartered group, they've needed to make sure there is enough documentation in Australia for the Australian operations. So potentially that can help them globally, but groups will need to define globally what it is that they need to do. But that's very much the Australian perspective. Not sure others if you've got thoughts from what you're seeing in the markets.
I think also, Andrew, is a very interesting trend. So in Romania, we've not seen many disclosures with regard to tax strategy and ESG from in-scope groups. However, Romania was only the forerunner and the first EU Public CbCR case with a limited number of cases, and many groups still struggled with the new process. So my expectation is that starting from fiscal year 25, we will also see that in-scope groups adapt their ESG and or tax strategies to EU Public CbCR in Europe, because there are certain industries where that's quite prevalent already.
From a Southeast Asia perspective, my expectation is that ESG and tax strategy will evolve, at least as already indicated. There are groups that are interested in publishing more from an ESG perspective, and tax often by CEOs is seen as a low-hanging fruit. I think this is one trend. Another trend are the cooperative tax compliance programs in Singapore and Malaysia. For instance, the TCGF and the TGF CTRM, that is a tax authority-run program to support tax governance, and then that's linked to the publication of the tax strategy. Klaus, back to you.
So let me raise another question to Andrew then, which actually goes a little bit into the direction of a question we also just received in the Q&A box. Andrew, multinationals caught by both EU and Australian CbCR rules will need to disclose information across a range of jurisdictions, including key European markets, major financial hubs like Singapore and Hong Kong, and also traditional offshore locations, BVI, Cayman Island, etc. Who will define the minimum level of external information reporting? Is this each group on a standalone basis, or maybe it's peer group?
I think it's both. I think one of the really challenging aspects of this type of disclosure requirement is that every group will have its own initial view. And even within a group, typically I would say tax teams don't want to disclose any more information than they need to, which is consistent with the response that was provided. But often others in an organization will have different views: sustainability teams, corporate communication teams, management teams that are looking maybe to tax as a link to sustainability-linked debt, so cheaper debt. So an organization itself will determine what it wants to produce, but equally peer groups can also define what you produce. And so if one in an industry does something and then another player in the industry does more, what does the first entity do? And that will be decided by each and every group, but there's a multitude of stakeholders that need to be considered. Andreas, you're a bit more advanced in this, maybe in Europe. What do you think?
I think, Andrew, I fully agree. I think the trend to match your peer group is a development we've also noticed in Europe. This, of course, makes responding to EU Public CbCR very, very challenging for many organizations because nobody knows at the moment what your peer group will do or is planning to do. So another fairly new development which we've seen in Europe is, as you alluded to, that there are internal stakeholders in many organizations that decide to use EU Public CbCR to drive their own agenda. So that's not only external groups, but also internal ones. An example is a case where you have a CFO who follows a total tax contribution reporting strategy, so quite broad, including all taxes, not only income taxes. This then, of course, requires substantial changes to tax reporting systems, including ERP, to generate the necessary tax data and information, which goes far beyond what is required for EU Public CbCR. So that's a new trend, which all heads of tax should monitor and be aware of, because that then, of course, is a much bigger game than only complying with bare minimum requirements in Australia and or in Europe. So Klaus, back to you, because you mentioned we've got some questions lining up for the Q&A session.
Indeed. Thank you very much, firstly, for the great presentation, the podium discussion as well. So this ends the formal part. So thanks, Andreas in Singapore, Andreas in Munich, Andrew in Australia. And we have quite a number of questions that came in, which is not surprising considering really a very high number of participation in this on this topic. Let me kick it off with a question, I guess to Andreas Kowalik. How many global groups will be subject to EU Public CbCR disclosure obligations altogether? What's the estimate? What do we know?
Yep. So of course, numbers are always a difficult one. Globally, we know from what the OECD has published in statistics that about 8,000 groups exceed the 750 million euro thresholds for OECD country by country reporting and also EU Pillar 2. So there's quite reliable numbers there. Most of them will have nexus in the European Union, and many will also have nexus in Australia. So the total number of groups likely to be globally affected by EU Public CbCR, and a lot of them also by Australian Public CbCR, is about 7,000 to 8,000 groups. So quite a high number. So globally, the largest number of organizations will be based in the United States of America with more than 1,000 groups. Interestingly, and also noteworthy here, is that Japan is probably the second largest jurisdiction with more than 900 groups. So already coming closer to Asia Pacific.
Wow, great. Thank you, Andreas. Another question, and I read here Australia, so Andrew, suppose this one's for you. Since the Australian rules do not require separate reporting for non-listed countries, do you think groups will choose to provide greater detail, or would they just report the minimum?
That's a really good question, whoever's asked that, and it's a really complicated one. And I think the answer today might be different to the future. And as Andreas mentioned before, this is a period of transformation for a lot of groups in working out what they want to do and how they need to respond to their peers. The conversations that we're already having with clients around their transparency approach is already quite varied. There are some industries, mining and minerals, they already produce a lot of information, and their social license to operate means that they've already produced a lot of information on a voluntary basis. Other industries are not as advanced in the transparency agenda, and therefore this is a really big step for them to make. I think as tax professionals, we haven't been used to sharing publicly information about how we are structured, where we pay tax, and why we pay tax. Some groups will be very efficient in their structure, and there's a narrative that needs to sit around that, and they may be more reluctant to publicly disclose their affairs. So what does that mean for what you're doing? I think it means you need to start off with looking at the minimum requirements, but also looking at what your peer group is doing and who your external stakeholders are that you're trying to talk to and convey this information to. You need to then be willing to take on board the feedback from the internal stakeholders, because from experience, some of those will want broader disclosure than what the tax team might want. And then you also need to make sure that you're willing to adapt. As I said earlier, you might start off with a particular level of reporting, and all it takes is one organization in your industry to do more than you, and then you need to consider how do you respond to that. Alternatively, you might look around at your industry as part of a planning stage, realize no one is doing anything more than the bare minimum, and think to yourself, do we have an advantage here by producing more? And that's going to depend or be answered differently for different organizations and different industry groups. So I think to answer the question, it depends. It will vary from organization to organization and industry to industry, but it is not a strategy that you can define in isolation. And it is not a strategy that I would describe as being set and forget. You'll need to look externally to the organization and work with others that have that visibility to best position you strategically. What do you need to do? And then also have a plan as to how you respond to changes from others in the industry. So I hope that helps. Back to you, Klaus.
Great, thanks, Andrew. Yeah, Andreas Kowalik, which EU member state has the most local groups that are subject to EU Public CbCR?
Yep, so that's an easy one. So Germany is the largest EU member state. So we know from publicly available information that about 800 German groups, so Germany headquartered groups, will be subject to EU public country by country reporting from fiscal year 25. So globally, this makes Germany the third largest jurisdiction after Japan. So that also makes Germany as an interesting for many non-EU based groups. So for example, Asian headquarters groups who can freely pick their EU disclosure jurisdiction. Most Asian groups have sufficient nexus in Germany for purposes of EU Public CbCR in order to make Germany their central EU disclosure and filing hub. Germany has locally also implemented the so-called website exemption and all the other elections from the EU directive in a quite business-friendly way, which makes Germany attractive and flexible as a disclosure hub. And then there's another example, advantage, which you saw from the template in Romania. Nobody speaks German globally, so nobody can read the template you publish in Germany.
I guess that's a good thing. So one final question, I guess, is what we have time for. Do you think Ireland will be exempted on website disclosure?
Yeah, so that's also, I can confirm this one. So Ireland has implemented the website exemption. So Ireland is also one of those countries that could be considered. The downside with Ireland, as I mentioned, is you can comply there. So they have a register, you have the website exemption. The problem is you publish in English, which of course is legible to everybody across the entire globe, because usually everybody speaks English. So that may be a pro or con, depending on what you want to do.
Right. Okay. I have 2 or 3 more questions here that are probably interesting to be discussed or to be answered. But I think we have to get back to those asking and handle that offline. So unfortunately, we come to the end of our session already. Special thanks to all of you who were able to join us. We'd like to encourage you to fill out a short survey that will pop up on the screen in a moment and tell us whether this was good and what is your feedback. If you join us late, please note that the presentation will be archived for future viewing. If you feel that others would benefit from the webcast, please share the webcast via the share this icon or have them visit the Dbriefs website. We will respond to all the questions submitted during the webcast in a couple of weeks. Give us a bit of time there. If you think of any other questions or comments afterwards, just reach out to any of us and we'll happily reply to you offline. Let me make some marketing. So we'll have our next webcast, which is called 2025 Japan Tax Reform Proposals, Striking a Balance, which is coming on the 6th of March at 2 p.m. Singapore time. And finally, from all of us at Deloitte, thanks for your participation in Deloitte's Asia Pacific webcast series. And I guess we'll wish you a good day wherever you are, wherever you join from. Bye-bye.